Welcome, ladies and gentlemen. Let's look at our homework that I've given you. Make sure you've turned to 2.8 in your study guide, exercise 2.1 on page 16 of your study guide. Let's start with the given information. The following information was taken from the accounts of Blue Red Traders, a partnership with B Blue and R Red as partners, and we have a 30th of September 20.1 year end. That year end is very important, please. Then we move on and we have these balances at 30th of September. This is not a financial statement. In essence, it's an extract from the trial balance, and usually they would give you some indication of debit or credit, but here they've been a little cheeky and they've put it all as positive numbers, which means you need to know which way round your accounts need to be. Remember, our accounting equation is assets equals equity plus liabilities. If we do a little tier count below each of them, assets get bigger on the debit side, equity gets bigger on the credit, and liabilities get bigger on the credit side. Okay, now under equity, you're going to have income and expenses. Income gets bigger on the credit side, expenses get bigger on the debit side. The net is hopefully a net income, a net profit, which will then make equity bigger on the positive. So income makes equity bigger, expenses make equity smaller. Now let's get stuck in. Pull up a highlighter and we can go do a read through this question. We have capital accounts for blue and red, both fixed at 20 and 5. We then have current accounts for B blue and R red. Both of them are in credit balances, which makes your life a bit easier. But take note, 1st of October 20.0 means those are the balances at the beginning of the year and nothing has been done to those accounts. We then deal with drawings. Drawings for blue and red. Remember, these are going to have to be closed out to the current account at the end of the year. This is where we've kept track of actual monies or assets or expenses from the partnership that are taken out by the partners. We then go through and we deal with the individual accounts. Mortgage is a liability. Creditors control, a liability. Bank overdraft, a liability. Remember, liabilities here all have credit balances. Land and buildings at cost, that's an asset. Equipment at cost, as well as the accumulated depreciation on the equipment at the beginning of the year, will be an asset. Remember, you net the two off to get the carrying amount. Motor vehicles along with accumulated depreciation, once again beginning of the year, gives me carrying amount. Office furniture less accumulated depreciation gives me the carrying amount. So we still need to do depreciation for the current year, don't we? Okay, we haven't done it yet. Inventory, another asset, that is at the 30th of September. Debtors control less my allowance for credit losses, again beginning of the year, is an asset. Remember, debtors is made up of gross less my allowance for credit losses will give me my net debtor on the face of the statement of financial position. Petty cash, another asset, that's a cash amount. Just remember that is also falling under financial instruments. Okay, for disclosure later on. Okay, so we're done with assets, liabilities, statement of financial position, which had all the equity accounts as well at the top. What's coming up next? Income and expenses. So sales is income, cost of sales is an expense. Those two together will make up gross profit. Advertising costs is an expense, salaries and wages. This will exclude the partners. Remember, partners' salaries goes directly to the appropriation account in equity. So salaries here is just the expense. Admin expenses, insurance, carriage on sales, Take note, it's a carriage on sales, therefore it is below the gross profits, not part of cost of sales, right? Carriage on purchases would be part of cost of sales. Carriage on sales is part of selling, admin, and distribution expenses. And then my interest on the mortgage, that is a finance cost. We disclose that separately, right? But it's still an expense. Good. Now we move down and we're going to have a look at the extra information. They give us the terms of the partnership agreement. The partners share profits and losses in the ratio of their fixed capital. And if I remember correctly, that was blue had 20,000 and red had 5, didn't he? Yes, 5. So 20 versus 5. Okay, and the total is 25. So it's 20 out of 25 or 5 out of 25 for the ratio split. Interest. Interest is being charged at 5% per annum on the opening balances of both the capital and the current accounts. And that is done annually, guys, 5% per annum. Then interest is also charged 5% per annum on that, sorry, not per annum, cleanly, but on the average monthly amount on the drawings account. Now we've got to ask ourselves, have we got enough information to calculate that? Not yet, right? So there's got to be something else later on. So let's just put a little question mark. We know we've got to come back to that. Then R red is entitled to a salary of 1,000 and a management commission of 10% of comprehensive income after salary and interest. Okay, so we're going to have to do a calculation for that. Moving on, let's now have a look at year-end adjustments. An outstanding debt of 20 Rand is irrecoverable and must be written off. Let's just do that right here quickly. So working 2.1, we're going to write off the debt, and there we're going to go debit credit loss 20, and we're then going to go loan receivable. Okay, then specify where that was sitting as a debtor or if it was a separate loan, but what we're worried about is the credit loss of 20. Then the allowance for credit losses must be adjusted to 800. What was it? The allowance for credit losses at the beginning of the year was 600. Let's do the quick calculation. Working 2.2, the allowance for credit losses, opening balance was 600, closing balance was 800, therefore it is increased by 200. If I increase the allowance for credit losses, I must decrease the debtor, right? It's a sub-account. So let's just think about that. I will go debit the credit loss expense, 200, and I will then credit my allowance for credit losses, which is a debtor sub-account, and debtors get smaller on the credit side. Okay, so that's working 2.2. 2.3, depreciation is to be provided for as follows. We deal with equipment, 15% per annum according to the diminishing balance. So I'm going to need the opening carrying amount less depreciation for the current year. Okay, but the opening balance, total carrying amount times 15% will give me that depreciation. But they've been a bit tricky here. They said a new machine was purchased on the 1st of April 20.1 for 1,560. So we're going to split up the depreciation on the old machines versus depreciation on the new machines. Let's go and do that on a new page. So working 2.3, depreciation. Let's first do equipment. And we'll do the old equipment first. Okay, so going back to our balances, our child balance, we had equipment of 19,840. That includes the new machine, right? So we're going to have to adjust that. and 5,000 accumulated depreciation beginning of the year. That's on the old machines only, because the new machines hadn't been purchased yet at the beginning of the year. So let's go and do the old machine first, right? The old machine first will be the 19,840 total cost at the end of the year, minus the new machine of 1560 gives me 18,280 cost on the old machine. I then take the 18,280 cost minus the 5,000 accumulated depreciation gives me 13,280 carrying amount beginning of the year on the old machine. Depreciation now will be 13,280 times 15% times 12 over 12 months. We had that old machine for the entire year, right? And I can put that in straight away in my total of 1,992. The new equipment is very easy. I'm going to take the 1,560 times 15% times 6 over 12 months, all the way from the beginning of April. So the 1st of January, February, March, April, the 4th month, all the way to the 30th of September, 6 months. Okay, and that gives me depreciation of 117. Let's continue. Let's now look at what was next. Up next, we're doing motor vehicles, and that was 20% per annum according to the straight line method. That one's nice and easy. All I need is cost and, well, this time they haven't given us a residual value at all, right? So motor vehicles, cost of 900. Okay, so motor vehicles will be 900 times 20% straight line times 12 over 12, and that gives me depreciation of 180. Okay, last we have office furniture, 10% per annum according to the diminishing balance. Once again, no residual value noted, so they're keeping this nice and easy for you. So here we'll need the cost minus accumulated depreciation. Cost is 350, accumulated depreciation beginning of the year is 50. So furniture will be 350 cost. Furniture is on reducing balance or diminishing balance. So 350 minus accumulated depreciation to the beginning of year gives me a carrying amount of 300 times 10% times 12 over 12 months, and that gives me 30. My total depreciation then comes to 2319. Now, ladies and gentlemen, there's a lot of marks in there, please. You have to do from any workings you reference to your working 2.3 when you get to your solution, okay? Because if you get one of these figures wrong, and chances are you will make a mistake, you'll be under pressure, right? You don't want to lose all the marks. Always reference and make sure your workings are marked out clearly. Okay, so depreciation is done and dusted. Next up, we now deal with interest on the mortgage loan to 30th of September amounts to 600. But if you recall, we only had 450 in the trial balance. What's happened here is probably the interest that's recorded in the trial balance is what was actually paid, not necessarily what was fully accrued, right? So I'm going to have to go and we'll call this working 2.4. And these workings you should be doing on your exam paper, guys. I'm doing them close to the information so that it's easy for you to follow, right? So I'm going to have to increase my interest expense, debit it by 150, being the 600 minus the 450. And then I will credit one of the liability accounts, 150, either accrued interest or directly to the mortgage loan. Okay, 4,000 the loans repayable. The loan is secured by mortgage over land and buildings. Loan was granted on 1st of October and bears interest at 6%. This is all disclosure And just remember, 4,000 of the loan being repayable in the next year means that this is going to be 4,000 Rand being the current portion, okay, and the current liabilities. Next up, we then have salaries to employees of 69 Rand have not been paid or taken into account. So I'm going to need to do a working 2.5 and make salary expense bigger. Debit salary expense 69. And I'm going to credit, what should we credit? This credits our trade payable, some type of payable, right? We'll see which account it's going to go to a little later. Okay, now we've got a bit of a tricky one. The following expenses have been prepaid, 62 and 948. So if I go back for insurance of 364, I need to deduct 62 Rand from, right? Because it was included in the expense when it should have been expensed in a future period. So insurance, I'm going to debit prepaid expense. Excuse my shorthand, my space is a little tight here. And I'm going to credit insurance expense. $62. So I'm going to make the expense smaller by 62 Rand, and that's exactly what I'm doing. 364 minus 62. The other one was advertising. Advertising of 4409. I need to deduct 948 from, right? And I'm going to pass that as a journal. I overpay or overexpensed. I included too much expense in advertising expense, so I will take some out and I will move it to a prepaid expense, an asset. There's a future benefit. Okay, I've still got to receive the services on this advertising, and I will credit advertising expense. Okay. Now the point of this read through, ladies and gentlemen, is this is what you need to be thinking about. Okay, you obviously need to do workings for all of these as well, so you can write down your workings now or later on when you need them, but you must be thinking about this as you read through the actual question. We are almost there. Interest calculated on the partner's drawing accounts was 320 for blue and 80 for red. Remember up top here, when we first looked at 1.3, we knew there was going to be an issue because they did not give us enough information to calculate the interest on the drawings. So I'm just going to write here, refer to 2.7. I think it was 2.7. Yes, it was. Okay, so we've got the interest on the drawings, 320 and 80. Then in terms of the partnership agreement, the following must still be applied or provided. Interest on the partner's capital and current account, and R-Red salary and management commission. You're going to take that to the appropriation account. Right, we've gone through quite a bit in this information. The most important thing here is going to be your required. Now, they haven't given you a specific mark allocation, but I'm telling you now, this would be huge, guys. Obviously, they will not give you all of this in an exam. They will generally, I'm betting on a statement of changes in equity, because that's where the real nuts and bolts of a partnership accounting come through. But they could give you a statement of profit and loss and one of the notes. They could give you a statement of financial position and one of the notes, most likely the PPE notes. They could ask for the appropriation account GL. They can ask for a lot of things. We're going to do everything now with you. But remember, this is not the size of an exam question. It's probably just going to be some components of this question. So first up, A, prepare the following in compliance with IFRS for blue-red traders. First of all, the statements of profit and loss and OCI, then the statements of changes in equity, statements of financial position, and then the notes. Then they want you to do the current accounts properly balanced in the general ledger, all for the year end 30th of September, show the correct contra ledger accounts, and show all calculations. Great, guys. You're going to have a lot of work to do here now, right? I want you to make sure you go and attempt all of these, right? First of all, I'm going to ask you, just for this question, to please, I want you to do all the journals for the equity accounts exactly as I laid them out for you in the journals. Okay? Then I want you to do all closing transfers. And I want you to do journals plus the general ledger accounts for all of them. Do that, then you're going to watch the videos as I do that. Remember, that is not required and you will not have to do that in the exams, but I want you to make sure your thought process is correct. So we're going to do this slowly, step by step. Once we've done those, we will then post and take to the statements of profit and loss, changes in equity, etc. Okay, make sure you do it properly, put the solution away, have the journals out that we did together. I'm happy for you to copy those out and just fill in the numbers, but you must learn them. Okay, get cracking, guys. Do this properly, please. Thank you.